Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today on this edition of Conversations, we get to bring on Chris Bird. You may know him from his Twitter rants or him being in a Reuters article, but we'll turn it over to him, let him introduce himself, and then we'll just start talking energy. And luckily we'll be able to talk physical, what's happening in the E&P world, and then what are we doing on a trading side.
Cool. Well, thanks for having me on, Mark. So my background is that I am a petroleum engineer by education. I worked out in the field for 5 or 6 years doing completions production work, and I came back and started doing some acquisitions, divestitures type work, and kind of started seeing like how to value oil and gas companies that way. And I did that for several years for a private equity backed company called Bluestone. And then about 4 years ago, I went out on my own and I raised some capital and started a production company, which we still run, called Exponent Energy. And we do actual physical production. We've got about 350 operating wells across Oklahoma and Texas. And we sell, call it 1,200, 1,300 BOE a day. And then in addition to that, I do run a small fund that we do historically primarily short energy equities. And that's been the breadwinner for several years now, as the production company is a laggard, obviously, commodity pricing.
Well, it's interesting that you talk about that now, because you're clearly looking at some of the E&Ps, but then you have your energy company. So when you talk about what you're doing, can you kind of go through what is it conventional? Is it unconventional? Are you looking to short unconventional and you like the conventional play? How does that kind of work in terms of how you're thinking and how you're positioned?
Yeah, I mean, the way I kind of pitch it is that they're sort of a hedge against each other. So, we have a lot of common investors across both groups. And so basically we can say, commodity price doesn't perform well, like we'll make money generally on the short public equity side. If commodity price does perform well, we'll generally lose money in the fund, but we'll make a bunch of money in the production side. And, that's not as formal as like it could or should be probably. It's a pretty tight-knit group of people. So right. I think we have a lot of trust in each other's judgment to just kind of say like, it makes sense right now to be net short, net long, whatever, right? But I mean, traditionally, historically, over, the last 5 years, really until the big collapse that happened, in March, we were almost totally short public equities on the unconventional side. And for me, like as an engineer, like I approach it like an engineer. So, we go in, we pull all the public production data, we create a, full decline curve analysis on every single well that is producing for that public company. And we basically try to grassroots create the exact same work we would create as if it was an asset and we were going to buy it. Okay. And so we try to understand the geology, we try to understand their land, we try to understand engineering, and we try to really what I try to get down to, and it's not a metric that non-engineers like, but I want to see what I call, PV10 of the PDP, which is like what I would say is a liquidation value. And then you would say, I want to understand what the upside here is, because if they've got a ton of great wells they can go drill that's going to dig them out of this big hole they're in, then I want to know that too. So, we try to get a good feel for the inventory. We try to get our heads around what we think production looks like for the new drills and a PDP number. And then we just look for big discrepancies in the value between what the asset value is on that using those metrics versus what they're trading for in the public market. Right.
So when you're going through a lot of this work and going, let's just say well by well on an asset level, what kind of basins have you come across, or what kind of areas where you're like, wow, these wells are actually pretty good and could see some life even after, let's just say, capitulation to the downside on some of these crude contracts. And when we look at how this looks going into 2021 and beyond, I mean, is there an area that we should be looking at, or that you like, or you think has some value even after we at these price levels?
I mean, yeah, I think you could say, I mean, traditionally, historically, like some basins are drilled up, some operators have more inventory than other operators. I mean, you can look at North Dakota and you've got a real, $6 million drilling completion cost up there, and you have a lot of McKenzie County core acreage available open for certain operators, particularly like ConocoPhillips, right? Like they've got a ton of inventory, and so 400,000 barrel EUR, say 6-7 wells per drilling unit, which would be 2 sections in a row basically, and so they can go mow down 7 wells and make 400,000 barrel EURs for $6 million a pop. It's pretty good. They're making money. But the problem is that if you look at it independent of the operators, different people have different inventories, right? So like the Whitings of the world are totally drilled up, right? And that gets into like a really interesting like topic that I love to discuss. It's like, why are they so obsessed with keeping production flat or growing, even to the detriment of their balance sheet and their economics? Because they will come in and they will downspace, beyond the rational reason that they should be. They'll lose money doing it, and that's exactly what Whiting did, and they downspaced things to 12 wells per unit when they should have stayed at 6 and 7. And you've seen it with EOG in Karnes County, right? So it's a very complicated question, because you got to understand the operator, you got to understand the basin. But broadly speaking, of course, there's running room in West Texas. I think you could say, in my opinion, homogeneously, the Midland Basin is over a larger area, more homogeneously decent. When you go to the Delaware, you've got some advantages in particular areas like the state line area, Lee County, where there is still a fair amount of running room, and certain operators that have good positions there are going to do well. But it's really dangerous, I think, to paint like broad strokes across whole basins, because you could easily flip on, like, let's pick on Marathon, right? Like they've got 2 core areas in the Bakken. One of them's great, one of them's terrible. So, they tell you they've got all this inventory left up in North Dakota, and it's like, you do, but it's on the acreage that's no good.
Right.
So what is that getting you?
Yeah.
So.
Well, and it's one of the things that we've been talking about for a long time, and something I've been harping on as we saw all these new refiners getting built in China and getting built in the Middle East, was there was coking capacity. So they're built complex refiners, which means that you need a heavier cut of crude versus what's currently available or will be available as we go forward. Everyone likes to talk about how there's been no investment, but then you look at Lukoil and some of these other guys, and they've been investing in Iraq. You've seen investment in Nigeria. I'm sorry, in the neutral zone. And then Nigeria is kind of like this unknown of who's investing. Shell's been there, and as you shift to the U.S., there's still a crude quality problem, because when you look at the Delaware, you have a lot of condensate. You get very light in terms of the API, which is like when you talk about Conoco. I love Conoco because they've done a good job of creating the midstream, creating the splitters so that I can separate out myself. So then I can sell my condi, I can sell the naphtha, and then I can sell a higher grade. And then you have obviously water contact. Because as you go into the Delaware, you get that water, where the Bakken, even though it's still light, it has a little less paraffin, has a little less heavy metals, sodium. So even though you're at a disadvantage from a geography level, you still have a great quality. And if you look at the flow down from the Bakken down into the Gulf Coast, you have this great opportunity where you can take in Gulf of Mexico, you can take in Bakken, and then you can take a little bit of Eagle Ford, blend it together, and what do you have but a fantastic 34, 36 API crude that can get blended into pretty much any refiner that's operating in the area. So that's why it's like this interesting conundrum of, well, the Bakken's far, but if you did it right, there's some decent opportunity up there, even at this price tag. Now, when you're looking at this, I mean, how important is it when we start thinking about, well, we're at 40 like you said, are we drilling at 40, or are we just trying to bridge a gap on a decline curve so that when we do see 50, we're not trying to climb up this huge hill to get back to flat, or are we trying to manage, like, how are you thinking about that as an operator to try to manage these moves so that you don't have a huge decline curve on the other side?
No, and I mean, it's interesting, and I think the public companies, they have a lot of externalities that, force their hand on doing things that may not make economic sense, right? So like, you've got firm transportation commitments, you've got rig commitments, you've got leasehold expiration commitments, right? And you have all these things that, and I think, public perception, right? I mean, you talk to analysts at these banks, and it's like they kind of scoff at the idea that you would let production fall. Like, it's just a given that you're going to have what, in engineering they call the wedge, right? Like, what is the amount of wells we got to drill to keep the wedge, to keep production flat? And the fact is that every well in history, or every field in history has declined. Every field in history has had an optimum spacing, and shale is not any different. And when you start to infill beyond where you should be, all you're doing is accelerating reserves to the front end of your curve, and you're sacrificing reserves at the tail end. And so these guys that are pulling a bunch of reserves forward are spending a bunch of unnecessary capital for the overall productivity of the field to get the barrels now to keep production flat. And I think it comes down truly to a lot of public perception on their names. And
Right.
So
when you start talking about downspacing and all these things, just for those that don't appreciate what that means, like when you get tighter and tighter, you increase the chance of communication, fractures start to go across, you start to lose pressure. And then as you lose pressure, the fractures start to close. And then what happens, you leave some of these hydrocarbons behind the well, essentially. Like and then you have to go in, and the ability to refrac is near impossible, because a pre-fractured well will just kind of absorb the fracture and not actually crack again. And all of a sudden you have all this potential hydrocarbon kind of stuck behind that well. So when you're looking as like a petroleum engineer and you're looking at these things going forward, is there an ability, like, are we still at the forefront of what we can actually get in terms of reserves in place, or have we kind of maxed out what we can do based on where we sit with current technology and abilities? Or do you think there is some opportunity to go from, let's call it 13% recovery rate to 25%?
Yeah, I mean, I don't believe that we're going to get incremental gains, step change gains, like the way we did in 2017, say, with the bigger completions. I don't see that being the way the industry makes gains going forward. I think where they do make money is, I think that you'll see the costs of drilling completions still continue to go down. And I don't think the wells will get better, though. I think we've more or less hit the logical scientific limit on how much production and recovery factors we're going to get out of these things, in my opinion. Okay. So.
And when you're looking out and you're targeting on the physical side, we've seen a lot of movement in propane. We've seen a lot of movement in NGL, specifically abroad. And obviously, if you've been to a restaurant, as they try to keep people coming to their spot, there's more propane heaters outside. I mean, are you looking at something that's maybe a little bit lighter? Are you looking at more oil specific, or will you go into the wet gas, dry gas? Like, how are you thinking about kind of those targets and acquisitions going forward?
Yeah, you're talking about as an operator.
Yeah.
I mean, I think what my personal view is probably on actual commodities and pricing in the future is probably truly on the acquisition side, because we depend on getting investors in our deals and all that, and people are usually pretty picky. The honest truth is most people aren't that interested in getting a petroleum engineer's perspective on future pricing of oil, right? Like, it's like, yeah, I mean, if I wanted, oil perspective, I would hire like an investment banker, or like, somebody that's done this analysis, not somebody that's like worked oil wells and drilled oil wells their career. So, I mean, I'm sort of handcuffed on like strip pricing, right? Mm-hmm. And so like, I kind of have to look at it from an acquisition side. Of course, I can have like underlying beliefs that, are under these theses when I'm buying something, but generally, we're using strip price and we're buying things because we think there's upside development potential in the field that's economic, or we think we're getting it for a decent rate based off of the cash flow profile, and so
Sure.
I'll buy any commodity. I don't care. I mean, gas, oil, NGLs, whatever it is. I mean, if you're going to sell it to me at a discount and I can hedge away a fair amount of that risk, then that's sort of what we try to do.
Right.
Yeah.
Now, when you look at some of the tightness in some of the areas, especially if you start going into the gas side, I mean, what are you doing not only just on the commodity, but also maybe on the differentials? Have you seen an opportunity to hedge away some of the diffs, or has it been a little tight because of, the way people are positioned in the market today?
We've actually been a net benefiter from the diffs. In the recent history, we got crushed, 2-3 years ago, especially on the gas side in the mid-continent. So, we make, 3.5 million, say, like historically average. We've got some wells shut in right now, but probably that kind of potential to produce. And the mid-continent market was changed dramatically when you saw the midship line, the Cheniere line come in, right? And so, OGT, which is One Oak Gas Transmission, right, is sort of like a local intrastate market, and it's a big one in Oklahoma, right? But it's all tangled up with Enable. But the outlets on it and the outlets on Enable and the interconnectivity of all these markets with Southern Star and Pepple and all that, it created a lot of inefficiencies in that market. And really, when midship came in and just stole, what was it, a BCF? I mean, I think hypothetically it gets up to, but I'm not sure what actual rate it's producing or pulling gas out of the system right now. But when they pulled all that basically off of OGT, the whole mid-continent market just like whipped right back up to, a reasonable discount. And so, yeah, I mean, do I think like there's a lot of room for that particular market to improve? No. I mean, Waha, like, I'm not a West Texas expert by any means in terms of like markets, but I know it's been extremely volatile. I guess you would have to assume at some point when the infrastructure is complete and available and you've not getting all the drilling activity that everybody expected out there, then you're going to have a lot of room and a lot of pipes. And I would assume that price, snaps to something closer to NYMEX over that timeline of, 1.5 years, I would assume.
Right.
So
yeah, it's interesting when we saw it, Waha went negative again before. Was it 2 days ago? I think right now it's still trading obviously tight, and EXO has always been a fun one to joke about as EXO likes to go negative as well. And when you look at gas flowing through, and when we saw the issues with LNG and a lot of these shut-ins and deferrals, I mean, you said that you had some wells that are currently shut in. I mean, how did you respond, and how was your reaction to, like you said, you were positioned pretty well on the fund side as you went into March, but obviously we had a huge impact to demand that continues to reverberate through the system today. I mean, how are you managing those shut-ins versus coming back on? Is it really a differentials question, or is it something a little bit greater than that as you're looking at a strategy side?
Yeah, I mean, we were, I guess, I guess you can't call it luck because I think we kind of saw it coming, right? It was the same reason we were net short on all the equities in January. I mean, we were short hard on the equities starting in November of the year before, and we followed that and bet harder and harder and harder. I actually got a nice sized margin call in January, literally the day before things turned, and it just kind of it progressed, and then it took off in March. But in my opinion, we looked at, I thought it was crazy that oil price and gas price had hung in as well as they had up through, March 6th when things kind of turned 6th and 9th. And, we just kept betting harder and harder. And on the production side, we just kept, selling more and more swaps basically until I got to the point that we were like, I mean, I hope my banker doesn't see this, but we were like 110% hedged on volumes on a net short position for our volume. So we're still in that right now. So like right now we're, twice or 110% more oil hedged at $52 in October, November, December. And that was, my timeline. It was like I wasn't certain when things were going to hit the fan, but, I felt confident for 2020 that would be the case. So,
Right.
we hedged it all out through the end of the year. Come 2021, things are going to be a little bit different because I didn't go that far out. So now I'm sitting here thinking, like, if I'm generally pessimistic and bearish on oil price, which I am, and, the short timeline, I think, for 5 months, call it, that's 6 months. I'm a higher level of confidence that there's going to be issues in the oil market there, and so I'm sort of working that in like a maybe I could try to get out of some swaps and into some more options to try to juice the returns we'll make if I'm right and oil price turns in the next 3 months, say.
Yeah, so we started to get bearish in July of last year when we saw middle distillate all of a sudden start to price in a weird way, specifically in Asia. And all of a sudden it's like, all right, well, is industrial a problem? Like what is happening right now that's causing these issues? And then we started to see some cracks in the economy. Things started to get a little bit worse. And then all of a sudden you had the Fed step in September, picking up the repo market. It's like, all right, I've seen this repo game before, and it was right in the financial crisis. So all of a sudden things started to kind of come together, and similar to what you were thinking, I thought it was going to appear in energy first. Just because we had these decline curves, we have pressure. I mean, clearly we had the attack in Saudi Arabia, crude prices spiked $10 and then immediately fell $10 because that was the first time I really appreciated there was a lot of supply out there, and we don't appreciate the amount of supply that's sitting kind of behind these different tanks as much as we try to track the market. And then my view was that we had over kind of extended where we could be in the US market, like 13.1 million barrels just didn't make sense. Like we just didn't have the demand internally. We didn't have the demand externally. It's closer to maybe 9.5 to 10 over the longer term. But kind of as we go forward and as you talk about some of those prices and some of those adjustments, and if we really do see kind of this steady demand in the US at this 9.5, 10 million, I mean, where do you think is the best place to focus? Like, where do you think is the best place to kind of get in on the ground floor as you start to look at, is there unconventional that you like, or do you think conventional has a lot of opportunity in this strip based on the cost to do it, the cost to maintain it, maybe some untapped resources that you think might be interesting on call it a 5-year time horizon?
Yeah, I mean, the beauty of conventional is that, one, it's cheap. We drill wells for like $200,000, right? And so we can make a return that is probably competitive with any well in West Texas, I would say, but your whole dollar number isn't big enough to attract big money. And that's right. The problem with conventionals is that you can't move large sums of money into it. But you can make good returns if you're smart about it and you watch your costs. And so historically, big operators, mid-independents, pubcos just never can pull that off. And so we live in that niche, and I like that niche, and I hope that people talk bad about conventionals. I'm like, yeah, you should never do that. Like, keep drilling $10 million horizontal wells and enjoy that. But, the private equity boom and everybody, a lot of ego is involved with that. And everybody, feels really cool about having a $300 or $400 million commitment from private equity so that they can go spend $50,000 an acre and drill $10 million wells. But at the end of the day, you're always hoping that you would find some idiot to overpay for it, and that's not like a fun game to me. If I'm getting an exit out of a deal by some sucker overpaying, and that doesn't feel good to me. I like to generate ideas that I think work, that I like to put my money into. Right. So that's sort of my thing. So yeah, I mean, so yeah, conventionals, there's opportunities. There's going to be opportunities for smart people, good geologists that do the hard work, and are willing to take the risk. Those will be there. Your just scale is going to be de minimis in the equation of right. Production and money going into that. Now, on the unconventional side, I think my bet is the highly levered balance sheets start probably smash coing as the majors are going to pick up, of course. You saw the the Concho deal was a very logical one to do. The question now, it's like, what happens to Diamondback and these guys? And I think you're going to see, Pioneer probably gets picked up by a major, but I don't see the Diamondbacks of the world getting picked up just because of their lack of inventory and the amount of debt they've got. And so I think they'll probably combine to sort of give themselves some more longevity on, their lives. The Diamondbacks will team up with, whoever that's got a bunch of debt. They'll cut their G&A and they'll try to survive that way. But long term, I don't think that there's like a real solution there where the equity value gets salvaged. I think that, there's too much debt and oil price will stay low too long. And so I think in the long term, you wind up with a scenario where consolidation happens, capital starvation happens, people dramatically overestimate how much inventory there really is. And that gets into some like more technical stuff, but the fact is that the Bakken is very downspaceable and it's very successful when you drill offsets because of, basically, ironically, what you're referencing with the crude quality that you get out of the ground, but it also makes a big difference when it's in the reservoir. And so when you've got a high bubble point oil, like when the gas breaks out of solution in the reservoir, your recovery factor that you referenced is 13%. If that happens early on in the life of the well, that recovery factor drops dramatically. And people saw that in the stack. That's what people got wrong in the stack. You had a really high bubble point. And when you'd come in, you'd drill an offset well, 400 feet away, you were already drilling into a well with a free gas phase in it, and the recovery was miserable. And so the Bakken, that works in your favor because you've got a low bubble point. In the West Texas, and again, it's like Delaware versus the Midland, right? Midland's got a lower bubble point, and so it's more downspaceable. The Delaware, working in its advantage, you've got higher in situ pressure, but you also have a higher bubble point, and so your recovery factors on your offset wells will be lower going from, and so it's a really complicated equation. It's very area dependent, but I can tell you with 100% certainty that the inventory of well locations in West Texas is dramatically overestimated.
Now, when you look at some of the things, like my running joke always, especially last year, was Concho's worth $50, act accordingly. It was trading at 80. I'm like, it's worth 50. When it went to 42, I'm like, look, it's still worth 50. I'm not changing my tune just because it's contiguous. They have, the opportunity there. It was just a matter of, when you look at Concho and Conoco, again, the Concho connection makes a lot of sense because Conoco has that infrastructure where they can really kind of maintain, like you said, cost. Cost matters the most. And if I can handle my splitting, my movements, and then Conoco has the ability to send, I can either send it to the coast because they were the first company to ever export from the US, or I can send it directly into a refiner and I can play that game back and forth, which is something that, like you said, with a Diamondback and some of these others, they just don't have that capacity. I mean, that's something that you have. And then, PXD is, much as we can talk about some potential conflict of interest between the two companies, there is they do have the pipelines, they do have the connection, and they were the second company to export into the global market. So there's, that firm transport, as you talked about before, can be a huge benefit. It can also be a huge headwind. And as you're starting to look at some of these projects, I mean, you've mentioned that costs are going up, but you've built a lot. There's a lot of firm transport sitting there that can be this overhang. I mean, when you're looking at some of these opportunities, have you seen any ability to pick up some firm transport for cheap where they're just looking to get volume? Or is it something where you're kind of staying away from that and just trying to pick your spots when you're thinking of it on an operating side?
Yeah, I mean, we haven't really run into that specifically. Like, I've seen some deals transact where, firm transportation commitments were moving off of a highly levered balance sheet to somebody that could spend a little CapEx, that it becomes a question of how much money will we lose versus, like the last guy. So there's an arbitrage, right? And I think a specific example of that maybe when, Oventive just sold some of their stack stuff to a company called Oliphant. And, I think they got a discount on PDP value because of it. And I think that, they will be able to probably move capital into an area that was probably not as interesting for Oventive, and maybe abet some of that firm transportation liability. You know, I think you'll see a trend too, as you've seen recently in the Rockies, where, you know, people are busting up firm transportation commitments. I think this is a real risk. Of course, when you've got enterprises going bankrupt and bankruptcy courts are showing that they're willing to break firm transportation agreements and midstream gathering and processing agreements, right? And so, you know, what's the next step? My guess, and I've been saying this for a while and I haven't been right yet, but my next guess is that you'll see private equity guys come in and they'll buy an asset off of Oventive, accept the firm transportation, or not Oventive, whoever,
right,
accept the liability, and then have a prepackaged bankruptcy on the front end with their bank and just take it down. Okay, we're bankrupt. Like immediately flip back out of it, have a prepackaged deal, break the firm transportation, and away we go. And I've predicted that for a while. Haven't seen it yet, but I think it would be a logical step. And I bet you did. I wouldn't be surprised if you start to see people start to do that. And I think it's a risk on the midstream side for people that have these big GMP contracts. So.
Well, we've already started to hear and see, and it's gotten some publicity now that they're just cutting prices. Like, it just seems like, you know, if you know it's coming, just get ahead of it. I just start cutting some prices, and I get you have to have, you know, you built this with an idea of a specific point in terms of return, and maybe you're not going to get that return. Like, you just have to accept the fact that it's not there, and instead of facing an uncertainty and bankruptcy, cut pricing. You know, cut pricing, just you get it, keep the contract, keep the crude flowing, and keep pricing. Like, one of the things that we saw as we got to the bottom of that, you know, completion side, as we got towards below 50, we were getting hit up from refining, for some refiners saying, wait, where's the feedstock? Wait, what's going to happen? Because then they're starting to panic because they need consistent flow, because, you know, you need to maintain pressure within the refiner. Like, you can't have that just drop off. And then you saw them paying up, like you've seen it in the Uinta and some of these other places that you're like, why are you drilling in the Uinta? And it's because it's waxy crude, and there's refiners that are built specifically for that oil, and you need to keep some of that flow. So you'll price at a premium, which is something that I think sometimes the market doesn't appreciate, that there's a lot of different places in terms of getting realized prices. And you know, we see two prices that are commonly quoted of WTI and Brent, but there's a lot of crude out there in different ways. Now, when you're looking at some of these things on the equity side, I mean, you know, you said that you're on mostly the short side, but is there a point where you're like, all right, Exxon is just cheap, like, or some of these guys just get to a point where it's like, all right, this is kind of foolish. Like, maybe we start to take the other side of the trade and we look at this for the longer term? Or is it something where you're like, look, oil's dead from this perspective, but I want guys that have exposure to LNG or something else, and you're starting to kind of shift that profile on the fund side?
Yeah, I mean, I think eventually, you can't stay bearish and short forever. You know, I dabbled in the long side. Really, I was, you know, I got caught after I was probably on tilt a little bit psychologically coming into the end of March, because we had been on such a good run, and I also was highly confident that commodity prices would continue to go down in April, which ended up being correct. But what I missed was, well, commodity prices and equities might disconnect here. And, you know, we probably lost $1 million in the fund in April. So missed that one. Oops. You know, and I think that's where, like, we're all evolving all the time. Hopefully we're all learning, right? And I've not been the traditional route of being in a fund and being trained and learned, and, you know, so some of these concepts don't come easy. But I've come to a conclusion. I think that you've got to start to, like, think about it as a commodities price game, and you got to think about it as an equities price game, and, you know, you have to separate them in your mind, and you've got to make the best trade off of which makes the most sense. And so, I think, you know, even in a good example of that is, like, being short a high beta stock when you have any degree of uncertainty in the commodity price, right? And if you're wrong, you can just get your face ripped off, even though, like, the stock is terrible and you know they're going bankrupt, but it might double, triple before that happens. And you saw it with Lin Energy before they went under. You've seen it with other names. And so I think it's really tricky to be short down here. because the garbage rally can kill you, and you want to be short garbage, of course, especially if you're like a technical guy like me. So, I think, you're going to want to be long. I think the way I, in my mind, have kind of how you deal with the risk at that point is that I think the yield, if you can find yield stocks, like there's some in Canada, like, Blackstone Minerals maybe is an example in the United States where you just say like, this thing probably will not trade at an absolutely unreasonable yield if they've got the cash flows in a long-term basis to support it. So it's, if you've got a double-digit yield now, like, is the market going to let it get to 20% if it's covered? Probably not. And so that's sort of like my risk way of dealing with that is trying to stick to yield.
Mm-hmm. The one of the things that I learned the hard way was in 2009 with the quote-unquote dash to trash. That became the run where all of a sudden you saw things. It's like, this should be going bankrupt. And that was when my boss at the time looked at me and said, you'll learn quickly, but nothing dies in a straight line. And you have to be careful. You have to be aware, like, you have your trajectory. That's fine. You can be bearish a stock. You can be bearish a company, but don't get married to it, because you need to respect the market. You need to respect what's going to happen and step away, and you'll get a better price to re-enter. He's like, you're trading paper. So just remember that it's an alphabet. It's just some letters that are organized in a way that has some meaning to you, but maybe no one else. So it's just, you have to act accordingly, to your point. And that's why, like, we always talk about, it's risk management, not investment.
Well, and I think it's interesting for me, at least, too. It's like, if you really think you have some proprietary skill set, something that gives you an edge on your competition, you still have to always remember what's going through their head, too. Because, like, if you're not considering it from their perspective and you're saying, what is the mob going to do, it could move dramatically against me. So, again, like, we're always learning, but I've started to think a lot about it, like, what is general perception going to be on this equity if this happens, right? Like, I might be right, my thesis might be right, but I don't want to deal with it when it doubles in 6 months. So,
and we've seen it before. We've seen it again, especially when you have these moves where the debt all of a sudden gets trounced and the equity moves, and you have to, like, well, it's also positioning. Someone might be long the bonds, short the debt, short the equity, and all of a sudden they're taking the trade-off. So the bonds are going down, the equity's going up. You're like, well, what am I missing? This is supposed to be me being right. I'm getting run over, and that's why it's like having that balanced portfolio in terms of picking your spots, but again, just respecting the market overall, just because you have to kind of see where things are going. Especially, if things can, as the famous quote is, the market can be irrational longer than you can be solvent. So it comes to pass. But when you start looking at maybe some of the oil field services, I mean, based on some of the guys that you're working with, what are you hearing on the ground in terms of what their views are, or what you're seeing in terms of pricing? Have you seen some deals come through, or is it they're trying to keep a floor in terms of the prices that you're getting on the operational side?
Yeah, I mean, I think, of course, like, when everything turned fast, like, you saw a lot of things shut down abruptly, and when that happens, you've got all the staff and all the equipment, and you've probably got some amount of optimism still, or you've still got, psychological things happening. But I think generally people tried to, bid everything down until it just, they were losing money, of course, like, operating. And then as time goes on, and, we've seen these busts happen too, like, it's funny because pricing busts versus operational busts don't always correlate. And I always talk about the Haynesville Shale coming in and like basically a bare gas market, but operationally it wasn't, right? It was like things are going crazy. So it was like, but now you've got the correlation between the two, of course. And so, yeah, I mean, I think service prices bottom out. You saw, overstaffed, over whatever, your emails getting bombarded, please come frack a well or put cement in this thing, right? And then like, okay, now we're going to lay off half the people and we're going to sell equipment, or we're just going to go bankrupt like BJ Services did, right? And like, I think that, in my opinion, honestly, like, I don't think that the service market in our country ever recovers to the way it was before. And, it's going to always be different. And I always use the example, my dad drilled wells in Western Pennsylvania before the Marcellus came around. And, they paid Roughnecks minimum wage back then. And, pre-Marcellus days. And so the, costs are going to adjust to make the economics for the producer work for the level that they'll keep activity going. And that's what you're going to see. And so, on a revenue basis, of course, that's going to translate to the service companies losing tons of revenue. And you'll see, of course, what do you get up to? Like 52 frac companies, I think, in the Midland, Delaware, West Texas basins. Of course, 90% of them are going to go away, right? And you'll be stuck with the big names again. All the small guys will be gone, and so but I think pricing probably rebounds slightly, but I'm not convinced that there's going to be a really good way to put money into oil field services for a really long time.
Well, that's the long way in terms of and just going back to your time as on the rig itself and doing a lot of this work. I mean, how different is it now? Like when you think about taking people off the rig, taking people off the well site, and putting them in, looking at computer screens, kind of doing some dual stimulation. I mean, how have things changed? And do you think that there could be a bigger adoption of technology to try to offset some of this cost and try to, I should say, maintain some sort of margin on a go-forward basis?
Yeah, I mean, the irony, as a completions engineer that sat my first frac in 2008 and did that for a long time for Chesapeake and the Haynesville. I mean, I've sat on thousands of frac stages, and I was the guy making the calls on sand volumes and adding cross links and things, right? And I can tell you here in 2020 that I'm a dinosaur,
right,
is the truth. Like when I hear people talk about horizontal completions now, I'm like, you guys are doing what? Like that's insane. Like sand costs like so cheap, and how many stages and how fast you're getting it done. I mean, the drilling thing is amazing. Like that we've pushed technology in 10 years that we're drilling Bakken wells and 10 days or whatever, right? I mean, it's just incredible. And so, it's worked. Like the old timers that are all bitter about everything, they don't like the fact that roughnecks aren't working floors anymore and things like, the flex necks on the H&P rigs, right? But the fact is that it's worked. The technology has been a huge improvement. It's made things safer. It's made things better. It's more efficient, more cost effective for the operator. And so, but I just think that, everything has a limit, right? Like you can't drill wells at an infinitely smaller amount of time forever. And I just think we are there. Like we're getting really close.
And when you look at some of these consolidations that we've seen, and we've seen some of this shakeup, I mean, is it just going to be some additional maybe consolidation, or like Liberty and Schlumberger might have been the first, and instead of going bankrupt, you just might start to see some consolidation to try to get some size, to try to get some scale, some economies of scale? Or is it something where there's just too much and we're just going to have to see bankruptcies to kind of purge the system at this point?
Yeah, I think you're going to have to purge, especially in the major basins like the, West Texas and stuff. I mean, I remember when I worked South Texas, there was like 2 or 3 frac crews that were there, and there was a Halliburton crew that was really good. And I remember talking to their salesman, and he said that literally this tiny vertical Halliburton frac crew is the most profitable frac crew in the entire company of Halliburton. And he's like, because guess what? There's there was 2 other guys that did it. There was like ProFrac and there was BJ, I think, doing fracs, but it was just hands down, they were the best. They were there, they were local, they were available, and that's, so you've got to it's just like anything. You can't make money buying a rental home if 52 other people are bidding against you, right? And you got to clear it out, and you can get back down to okay, maybe there's 2 or 3 frac companies operating in the stack again, and those guys can make some margin again, and but yeah, I mean, in the West Texases of the world, I think you've got to say for the next 5 years, it's just going to be absolutely brutal. There's going to be a ton of bankruptcies. There'll be consolidations, of course, but anybody that's got a balance sheet that's out of whack it's going to be painful,
Right. Yeah, and when you talked about some of the disconnect between commodity price and the equity price, and the running joke is, we're at 40, but a lot of these guys are still bankrupt at 50. So what are we doing here? I mean, is there, when you start looking at some of the opportunity, maybe for yourself on an operational side, like, do you have specific areas that you're targeting and saying like, look, I know those guys have running room that's running out. Nobody's going to put money in there. Let's just kind of circle this. Is there any area that you're more excited about from an acquisition standpoint?
Yeah, I mean, just because I don't do the horizontal thing, I mean, surprisingly, well, I'll put it this way. Most of the mid-independents and majors have shucked their conventional fields. That kind of happened. And, not surprisingly maybe, but like the small fields, the small operators that never got out over their skis, they're positioned to survive right now. Their banks are working with them, right? Because you can't go bankrupt well, you can, but you know what I'm saying? That unless your bank is going to tell you that, like, hey, like, we're done working with you. Like, when it gets contentious, that's when things go wrong. And I think you're seeing a lot of banks work with their customers now because they have to. Like, what's the point, like, of pushing you into bankruptcy, marking your debt down to where it should be, which is probably like 20%. I mean, and that, again, it gets into such a humongous discrepancy between like the carrying value on their books versus the real value. It's like the last thing they want to do is put a transaction into the middle of this thing to show that, like, oh my gosh, like, something that you said was worth, face value is now sold for 20%, right? Like, and it happened with East West Bank when they sold, Obenco, right? Like, it was like, oh my God, what just happened? You just sold something for like 80% less than you were carrying it on your books. Like, what else is on your books that may or may not be correct, right? And so they don't want those questions. That's a hard question, right? So they want to keep things tight. They want to keep things on their books, and they want to keep things just cruising along, hoping for kick the can down the road, and maybe commodity price saves them. So
last question before we let you go. We've talked offline about crude pricing and kind of what the expectations are. I mean, what's the play? I mean, do you think this is something where we see Cushing continue to build and we push back into the 20s? Or is it something where it's just kind of a slow bleed lower and then there's capitulation, and then we kind of have that slow grind higher back to the 60s?
Yeah, I mean, I foresee a capitulation. I don't think it's going to be as slow. I think you'll see a step change. And again, I think timing is an important part of that equation, because I wouldn't tell you that, this time next year we're going to be worse off than we are today. But I think you're going to say, like, if I want to focus on where I'm gaining confidence, I'd say like 3 to 4 months, right? Like, and what do I foresee happening? Of course, like you mentioned, Cushing's building, like, what's happening between, LSE, Magellan and, Brent pricing, and what's that telling you, right? And then you got to, like, focus too on China, of course, because they're the buyer of last resort. And so, what's happening with China, and, of course, it's always speculation, and you probably know better than I do, but it seems to me like they're working through inventory versus buying crude off the market, right? And so then they're taking all this refined product, they're dumping it in California, the CARBOB and all that, right? And so what is it all telling me? It's telling me, in my opinion, that you're dramatically oversupplied in the short term. And I think that where I see the catalyst for the whole thing, and there has to be a catalyst, and I think it's sentiment, and sentiment gets governed by the, wave after wave of bad news. And I don't think you have to necessarily say, like, this country, this consumption, if they shut down, it's going to take this many barrels off the demand market. I don't think any of that matters. I don't think that, because it's already, technically, it's not supported at $40. So it's just a question of, like, where is the mindset of the people that are in the market participants, and when that turns negative. And I think the catalyst for that is just coronavirus bad news in the market. And, what does that mean? Because I think the only thing propping us up right now is sentiment. So when that disappears, it's got to go down to the technical level.
And you get into a great point when you start talking about, like, behavioral economics and the way people are just going to shift their consumption patterns. Like, you just have an overall shift in the way people are going to look at things as you have COVID cases rising. People will inherently want to adjust just what they're doing. Like, you're just going to, you've seen it now. Like, there was a great chart before that was looking at, how people are essentially stocking up on toilet paper, soap, things like that in Germany. And if you consider, like, what Germany is in comparison to the rest of Europe, I mean, Germany is on the lower end of a COVID outbreak. So if they're starting to panic a little bit, it just takes a little bit of a panic where you don't need the government to tell you, look, don't go out. That panic alone is going to keep you out. You're just going to say, look, do I have to go shopping today? Can I wait till tomorrow, next week? And that I do think that capitulation is coming, and you're starting to see that kind of pick up, especially in the Midwest where gasoline demand is starting to fall. You were picked up by the harvest. That's starting to roll over as you get into mid-November. That starts to end. And I agree. I think it's just this bid. We just call it the God bid that shows up at $39.25 and buys it back to $41. We're like, what? Where did that come from? Who's buying that? Because like the running joke is like central banks are buying equities, but anybody of size that would buy crude at that level is already long oil. Like, why would Saudi Aramco buy oil at that price? Like, you saw this market order of 9,000 lots come across and sweep the market. You're like, who buys 9,000 lots at the market in WTI Cushing? Right. Like, that's insane. And it's been frustrating on the timing side, because I agree with you. It's all about timing. Like, you can be right, but if your timing is wrong, then you're wrong. And it's all about trying to marry that. So I agree. It'll be interesting to see. I keep thinking it's going to be soon, especially with again, like you said, the COVID cases starting to rise. That's starting to capitulate into the end of winter or the start of winter, and how that kind of grows, and people just get fearful and just stay home.
Yep.
So.
Yeah.
All right. Well, thank you again for joining us. It was an absolute pleasure. Hopefully we'll be able to convince you to come on once we've been right. We can talk about what comes next now that we're the oracles of trading crude.
Exactly. Yeah. Or we can come on if we're wrong, and we can wallow in our sorrows together. How about that?
Exactly. Well, thanks again. Coming up the rest of this week, we have our EIA show, our economy show, and then our favorite, the Primary Vision Frac Spread Count. So thanks again, Chris. Again, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.